Uh, all right. Hello, everyone, and welcome to tonight's advanced virtual training. My name is Desmond Hudson. I am going to be your instructor for the night. Tonight, we're going to talk about some advanced things that we do at the VITA sites. You guys should have already had the basic 1 or basic 2 class. And tonight, we're going to talk more about some of the law parts um, of VITA versus how to use the software. Advanced 2 is a class on software. All right. If you have any question as we go through this, please do not hesitate to ask. But we'll get started right away. All right. So welcome back for folks who have done the basic class tonight. You should have already completed the volunteer standard of conduct certification, as well as the intake certification and the basic. Right now, you're going to do the webinar related to advanced 1. And as I was saying earlier, there is an advanced 2 where you work on the software. So that's what you would do after this. And once you're done both of these classes, you can then get certified into Link and Learn. Today, we're going to review some advanced forms that you'll see when you're doing, when you get certified for advanced. And we're going to begin some of the certification exam and go over the scenarios. And we're going to do some polling questions to make sure that we all are on the same page. You'll have your PowerPoint and some polling questions to test your knowledge. The resources you should refer back to and have with you as we go through this class is the 4012. The 6744 is a test booklet that has the questions and scenarios in it. And then there's another one called a 4491, which is another booklet that kind of has a little bit more detail about the different tax laws, the tax law changes, how to input the information into TaxSlayer and things like that. I encourage you guys to take notes and take a record of some of your polling answers. They're very similar to the test questions. So if you can really get a good grasp and understanding of the polling questions, you could do a good job on inputting the information in Link and Learn.
Desmond, I'm sorry, but
Sure.
I don't have a 4491.
So you can get it online though. If you go into, they don't print them out as much with the IRS, but if you go to a website and do a pub 4491, they'll come right up. It's a nice tool. You actually would really like that, Michelle. You might want to check out the 4491. It's like a student handbook of everything. It's like it's really more robust information than the 4012. Yeah.
Oh, I think I'm gonna print that out and just make some copies tomorrow.
Yep. It's a really big book though. You might not want to print it out, but you definitely want to maybe make a tab and have it ready to kind of review it quite often.
Okay.
Yeah, for sure.
All right, cool. Real quickly, I'm so sorry. I don't want to have you go back, but can you just go back to that first screen, please?
Sure. This one?
Go. No,
or this one?
What did you start? Did you start here or the first one? Go to the first.
I started here.
Oh, no, go. I saw that. Back, go one more. There we go. One, go one more, 2. All right, now you can continue.
Right, and I can send this to you, Michelle.
Oh, that would be great. There
you go. I can send you this. That's not a problem. You ain't got to go through and take a bunch of pictures. I can send you this PowerPoint. That's not a problem at all.
All right, you heard the little clicker.
Yeah, I heard. You ain't got to do that. I got you.
Yeah, I just want to give people information.
Right.
Not
all right, so let's get started. All right, so what we're gonna do, like I said, we're gonna talk about some forms. You talked about like the W-2 and basic. That's like one of the most common forms you'll see. When we start getting into advanced, we start seeing forms like this one. This is a 1099 NEC, and that stands for non-employee compensation. This is a form that people will get that are self-employed. This will come for like maybe an Uber driver may get this because they get paid. Some of the money they make is commission money, and they may get paid in 1099 NEC, or somebody that is self-employed and they're doing contract work for an organization. They submit their W-9, and at the end of the year, they'll get a 1099 NEC from the person that they did some work with. And this is what they would use to create their Schedule C. So this is the income that they will put in to create their Schedule C. So on here, it tells you who the payer is, and I'll use my highlighter here to show you what this is made of. Let's see. So here you have like who paid you, what's the payer EIN number. This would be your either social security number or EIN number. If you have a business with a EIN, this is the name. This is you. You got paid from the person. And up here is the non-employee compensation. This is how much money they paid you. Mind you, this has no taxes taken out of it. This is just like a form. Like if I got paid cash, this is just equivalent to being paid cash. Here's a document stating this is how much I paid you as a contractor, and you need to put this on your taxes. And you can put expenses against it that are related to you doing this work. But this is the form that you'll get, and you need to wait for this form, especially if when you did some contract work. Don't do your taxes without it. You will get this at the end of the year. In addition, there's another form called a 1099 miscellaneous. In the past, this 1099 NEC used to be on line 7, and that's where all the information came from in the prior years. They changed it where now they broke out line 7, and now they call it a 1099 NEC. So the 1099 miscellaneous would be more for like other income. Like if I got money for like I won a prize on Price is Right or whatever, they may send me a 1099 miscellaneous saying, this is the value of the prize that you won, right? So here's some other income. So this is some of the things that would show up on a 1099 miscellaneous. If you get royalties for music or something you did, you may get a 1099 miscellaneous form that shows you this. People that do like multi-level marketing, they may get a direct sale saying, hey, you've gotten some money doing your multi-level marketing. I'm not giving you an amount, but you got something. So they would have to tell you how much money they made, but they'll get a box 7 with this checked off. But this is like one of those miscellaneous forms that catches a lot of income that either may not be earned income, but other types of income that they want to include or they need to include in their taxes. This one is a little bit more rare than a 1099 NEC, but you may see this as well. The next form is the big buzz that people are talking about, that 1099K. Congress has conversation right now where they're not requiring third-party networks or to kind of submit these transactions. What they did was that if you use PayPal, if you use Venmo, if you use Cash App, if you use Stripe, like all these different third-party, like basically people pay you through these third-party networks. If you had more than $600 of income, the 1099K, the rule for that third-party entity, the rule for PayPal, the rule for Venmo, was that you need to issue a 1099K to that person that they got that money. Now, this is only money that's related to business. This is not for friend or family and family sending each money, or you going out to eat and people, putting money all in a Cash App into you. It doesn't include that money. It includes money where if I have, a lot of people have Venmo business accounts, right? And they get paid through their Venmo. They get paid through their Cash App, on their business Cash App. That's what this is related to, or their business PayPal. That's what this is related to. And you'll get a 1099K saying how much of those transactions came through that. Like, so if I do taxes, I use Stripe as my payer. That's my third-party network. Stripe is going to send me a 1099K saying the people who use Stripe to pay me, I'm going to get a 1099K showing all the income that I receive from my clients. So the 1099K is similar to the 1099 NEC. It's just another way of reporting income. So whether you get this form or not, you still got to report the income. The whole buzz is that the form is going to go out to more people, because before, the threshold to get a 1099K was you had to have like $20,000 of income and have like, I think it was like 25, like, I don't know, I think it was like 200 transactions. So the threshold to get one of these forms was so high that they didn't used to issue them. So when people did not get these forms, of course, they didn't put it on their taxes. It doesn't mean you wasn't supposed to, you just didn't get the form to report it. They changed the rule and they lowered the threshold so that more of these forms would go out, and it would force people to use the forms to put the money on their taxes. And that's what the whole like pushback people were hearing about, this whole 1099K. They're going to go out more this year. Well, they're supposed to go out more this year, so more people's going to report it. They changed the rule at the last minute saying, you know what, third-party networks, we're not ready. We have some issues. You do not have to report it. That doesn't mean they're not going to. They're just saying that you do not have to report it based off of the IRS rules. And when I say report it, I'm talking about the third party network reporting the income that you receive. That doesn't mean you don't report it on your taxes. You report it on your taxes whether you get this form or not. The third party networks has responsibilities from the IRS to report to the IRS that I paid out $600 or more. That's what the rule is. It's not about reporting income as the individual. It's about the business reporting to the IRS that this amount of money has flown through it to an individual. If that makes sense. Go ahead.
Excuse me. Yeah, I mean, that makes sense to me. But in that case, I mean, it's just a question. If the business isn't reporting to the IRS what they paid the client, I know the rule that they're supposed to. Would the IRS know other than the client reporting whatever money came in?
That's correct. The IRS will not know. Just like
cash income.
Just like cash. Just like cash.
Okay.
The IRS wouldn't know, but the IRS rule is you need to report
all your
income you receive. So,
so it was just something I'm like,
yeah. So the excuse of I did not get a 1099K, but so you got to talk to your client, and if somebody said, "Yeah, I made $10,000 last year, but I didn't get a 1099K," well, you can't say that, right? You made $10,000. You just revealed to me you made $10,000. That needs to get reported. The fact that you have a 1099K or not, that's irrelevant. That's a reporting requirement for that third party business. That has nothing to do with you, right? So if somebody said that, they just reported that they had income, and I already heard it. I can't unhear it.
So you have to put it.
I have to put it in, right?
The second part of this is, since you said something, shucks, go ahead. It'll pop back in.
No, just jump in if you have a question. That's fine. Yes. That's fine. All right. So the next form is dividends. It's retirement. So people that have pension plans or take some distributions from their IRA.
I have it. I'm so sorry.
But it's fine.
All right. So with them not reporting, with the IRS not requiring the networks to report this money right now, when they do work out all their kinks, will it start from that year, or will they try to back folks?
Traditionally, they do start within the tax year. They don't usually go back, but it's the IRS. They can do whatever they want.
Some slick stuff.
Yeah, they can say, look, they can say in 2023 we're going to start as of December 31st, 2021. Report it, because the problem, the challenge would be, well, the third party businesses say, well, I'm pushing back because we didn't know we had to, right? And we didn't have the systems in place to do it. And now you're creating more work for us to do that. So they could push back. My gut tells me it would only be the year that they started. But it'd be tough for a business to just go back years and do something they didn't have systems in place to do.
And that would be just setting the people up for failure. Like, come on.
Yeah.
You set me up for something I didn't know. Okay, thanks.
Yep. All right, so the next one is retirement. This is for distributions. This is for took money out my 401k, took money out my IRA, my Roth, and they just paid it to me, right? So up here it talks about how much the gross amount that I took out, how much of it is taxable, how much taxes was paid on that. Some people don't have taxes taken out of it. Some people say, you know what, just tax it 25% or whatever. You want to encourage people, if you were doing tax planning with somebody, depending on their situation, they said you want to have taxes taken out of your retirement because it's added on to your other income, especially if you have other income. If I have W-2 or 1099 NEC and I'm having money coming out my retirement, I want to know, do I need to tax this? And maybe you do. There's different codes that you'll have on your 1099-R. There's a code 1 for taking money out early where you got to pay a penalty on it. There's a code 3 for disability. There's a code Q and J, and there's all these different types of code, and they're in the 4012. So I'm not going to go through all of them, but code 7 is a normal distribution, and that's somebody that's taking money out of their retirement. They reach their normal retirement age and are able to take money out of retirement without penalty. And that's probably the most common one we'll see. After that, you probably see a 1 code, which is somebody taking money out of their retirement early, and they got to pay a 10% penalty on it, unless they qualify for some relief for that penalty. And we can talk about that later in advance too. The other thing with the retirement, so this is a different 1099-R. The only difference is that you see the gross distribution, but there is nothing in taxable amount. So this is a unique one where the taxable amount was not determined, and we have to determine it at tax time. So there's some factors that come in play to determine it. Some of the factors include, when did you start taking out your pension? How old were you? How much did you put in? How much was your contributions? You do this kind of calculation, and that helps you determine, of this $14,000 I received, how much of it is taxable. So there's this, they call it the simplified method. There's this method to determine how much is taxable. So we want to make sure that we're aware of that, and we have a problem we'll do when we get into advanced to learn how to do the simplified method and determine it. And there's information we need from the client to do that. And some of the information is on the 1099-R, like your employee contributions, but the stuff that's not on here would be like, how old were you when you started getting your retirement? When did you retire? Like those type of information, you just got to interview your client to get that. So this is another 1099-R that it does not have taxable amount when we got to do a simplified method. Here is, I wanted to point out, sometimes there is a 3. I was saying earlier how that's a code that can be in your 1099-R. So underneath distribution code, there could be a code 3. If you ever see a code 3, that person received disability. So maybe at their job, they got hurt and their employer agreed to pay them a disability amount over X amount of years. So when that happens, you'll get it on the 1099-R. What this is about is if I did not reach my retirement age, so let's say I'm 40 years old, I work for SEPTA, and SEPTA has a rule that the retirement age for SEPTA is 55. I'm 40 years old, I got hurt on the job, and they're going to pay me disability income. So SEPTA is going to send me a 1099-R with the disability income, and my distribution code in here would be a 3. What I can do with that is I can treat this money as earned income. Normally, when you get money out your retirement, it's treated as unearned income. The importance behind that is the only thing that you can get certain credits on is called earned income. Like W-2 wages is like the main earned income. I worked to get this money. So if I have earned income, I can get what's called an earned income tax credit, which is one of the best credits that you can get out there for folks that have low income. So if I have disability and I did not reach my retirement age of my employer, like I was saying, let's say SEPTA said the retirement age is 55 and I'm 40. From 40 to 55, I can take this income and I can put it on line 1, which is where wages go, and treat it as earned income and allow me to get earned income tax credit. Because if I don't do that, this will not calculate EITC because it will look at it as unearned income. But once I check this box and say, you know what, this person's 40 years old, they haven't reached their retirement age, their code is 3, I want you to treat this income, this unearned retirement income, as earned income, simply so we can see if this person gets EITC. And they normally do because that's usually their only income because they're disabled. So they get the disability income, which could be maybe under $20,000. And I turn it to earned income. And maybe if they have some dependents, now they can get some really nice EITC off of this disability income. But once they reach their retirement age from their employer, so once they're 56, no longer can treat this as earned income. So you can't check the box after they reach that retirement age. I think I'll say at 55, right? So they can't do it then, but until then, they're good.
Oh, Desmond, quick question. I'm sorry.
Yep.
Now, is that something that calculates automatically from us putting their date of birth in? If we click that box, they know that they either qualify or not qualify?
So that's more, this one is more of a qualification off of our discussion with the client. So every employer has their retirement age, and it can be different. Some people can be 55, some people can be 59 and a half, which is the standard with
right.
Some people can have 50. So you gotta
So that's
ask
what
them.
so that client would have to know all of
The
this?
client, well, yeah, I mean, and I would think it's to the benefit of the client to know it, right? So you can like say, hey, I can treat this income as earned, and you can get a higher refund if you talk to your employer and find out what your employer retirement age is. If they don't know, I would go with the 59 and a half, which is the standard, but I would tell them to check because um it could be higher, it could be 65, right? And so you can
Right.
get to do it even longer. I would ask them
Okay.
to check with their employer and say, what is your retirement age? But I would push back on them and say, just call your employer, like, right, and let us know what it is so we can make sure,
Right.
especially if they're in that 56, 57 age, because
Oh,
55 is a good number that a lot of employers use. I would
mhm.
definitely push back on the client and say, just check with your employer and let me know.
Okay. So taking me back to my question, if I click this box on
Uh-huh.
any and every one that I see a 3, it's automatically going to give them EITC
It's
regardless of their age.
it's automatically going to make it earned income. Whether they get EITC is based off of, the factors of how much money it is.
Yes,
Do you
yes.
have kids? But it would automatically make it earn income and treat it like W-2. So it'll
Okay, so
be in
we
a,
definitely have to ask those questions.
you would definitely have to ask those
We
questions.
can't
Yeah. And
just assume, yeah.
yeah. So when we get to advanced two, there is a scenario where they give you information to help you determine whether or not this person qualifies. It tells you they did not reach their retirement age or they did reach their retirement age. So I can show you how that language looks.
Okay, cool. Thanks.
Interest. Interest income is pretty straightforward. You'll get a 1099 INC saying how much you receive in interest, and it'll report how much interest is. Here they have an early withdrawal penalty. This is if you had like a CD that you had for 5 years, but you cashed it in 3 years, you'll get a penalty for doing an early withdrawal. But that penalty, you can reduce your income with that penalty. So it's important to put that in there because it's an adjustment. It reduces your income by the small penalty that you get charged. Sometimes you see taxes on this, but this is pretty straightforward. You get like interest income, and sometimes you see a penalty. Sometimes people do not get this form if the interest was under a certain threshold, but that doesn't mean that money doesn't need to get reported, similar to the 1099K. That's because you didn't hit the threshold and the bank didn't have to report it because the IRS doesn't require them report it until they hit a certain threshold. Doesn't mean it's not income. So if somebody said, yeah, I had $10 of interest income, well, I need to put in that you had $10 of interest income, whether you have a 1099 INT or not. So sometimes you want to ask the question, did you have any other interest to report? And they may say no, or they may say, yeah, I had a $5. Cool, let me add this $5 in there, whether I have a form or not. This is a 1099 dividends. So dividends is basically money earned on stocks that you have, maybe in a portfolio. You have people pay out dividends on their stocks. And I think I lost somebody. Oh, that was the person, me. I lost me, it looks like. So the 1099 dividends, 1099 DIV is basically reporting your dividends. Here's something that I need you to understand about this form, though. There's ordinary dividends and there's qualified dividends. I want you to understand that this is all the same money. What it does is basically helping us understand how much of that money we want taxed at a lower amount. So for an example, this person had $2,200 of dividends. This is how much they didn't receive $4,400. They received $2,200 of dividends. Of the $2,200 they received in dividends, all of it, $2,200, is going to be taxed at a lower rate because they qualified. Qualified dividends are probably dividends that were for long-term stocks that you've been holding, that you've been getting paid dividends on. And I get to tax it at a lower rate than I would if it was just ordinary dividends and this box was zero. This had nothing in it. Here's another example. Let's say the total ordinary dividends was 2,200. The qualified dividends was 1,000. This is telling me that, okay, I only received $2,200 of dividends. 1,000 of it is going to get taxed at a lower amount, while 1,200 of it is going to get taxed at a higher amount. The qualified dividends just breaks out how much of this box am I going to tax at a lower rate? It's all the same money. It just breaks out how much of this box I'm going to tax at a lower amount. Any questions around that? Sometimes people think that this is 4,400. It's all the same money.
Okay, so you're saying between ordinary and qualified, the qualified just determines how much of the ordinary will be taxed lower.
That is exactly right. Yes.
Okay.
That's all that is telling me. It is not new money. It's not extra money. It's just letting me know how much of that ordinary dividend is able to be taxed at a lower rate. That's all it's telling me. And you said it a lot more simpler than I did. So thank you.
Okay.
So federal income tax withheld can be withheld on it as well. Sometimes you may see foreign taxes paid. This form is identical to a form that's inside of TaxSlayer. You just want to take your time and make sure you're putting 1A where it says 1A, 1B where it says 1B, and just kind of copy and paste the information over. This here is my 1099B. This is what reports my stocks transaction. So when I buy and sell stocks, it tells me information about what stock did I buy, right? What did I hold? When did I buy it? When did I acquire it? When did I sell it? How much did I sell it for? And how much did I buy it for? That's really what this form is telling me. So it looks like I bought it for $2,700. That's my cost, what I paid for it. And my proceeds would be what I sold it for. I sold it for $300. So I made $300 on it. And I got to pay taxes on the $300. The tax on the three. Say that again.
I have a question. It's Victoria.
Sure.
Did Mia drop out?
She did just now. It looks like she said she was going to have some issues because of her weather. Yeah.
Okay. I was only asking because the person in virtual was asking about her and said to keep an eye out on her because she's been having problems with her. And she thought that she was going to be here for a minute and then just disappear. But I told her what she told us, that she had bad weather. But yeah, she's been having problems with her. So she wanted me to keep an eye out. And then next thing you know, she just disappeared.
Yeah. So. Well, the good thing is that I'm recording this and she can refer back to this. Hopefully she doesn't have too much, internet issues, especially I think she's virtual. I think that's probably like, hey, make sure that your internet's going to be good as a virtual site director, whatever. So that's probably really important. All right. So this $300 is what's taxable. How it's taxed determines on how long the stock was held. So this date was January 7th, and it was held until December 1st. This is less than a year. So this is what we call short term. Something that was held less than a year is short term. A short term transaction is taxed higher than down here. You have a long term transaction. So this gain will be taxed at a higher amount. And then down here, you have the same situation. I acquired it in 2008. I sold it in 2020. So I held it a lot longer. I paid $1,700 for it. But when I sold it, I got $12,000. I got a really nice gain this time. But this gain is going to be taxed at a lower rate than this $300. All right. And so on this form, it just gives you all that information. Inside TaxSlayer, you're just basically copy and pasting the date, when you sold it, how much you sold it for, and what you bought it for. It also gives you information about bases. Up here it says short-term transaction, which basis is reported. Down here it says which basis is not reported. What that is telling me is this column right here is my basis. My basis is what did I pay for it? So up here, the IRS knows my basis. The IRS knows I paid $2,700 for it. It is reported. Down here, it says is not reported. So the IRS doesn't know that I paid $1,700 for it. So either way, you need to put your basis in, but it's super important to put it in when it says is not reported because the IRS doesn't know that you paid $1,700 on this. And if they don't know that, they're going to charge you tax on the full sell amount, which is $12,000. And I don't even want to pay taxes on 10. the difference between the two. And when you're in the system, there's boxes that says this either is reported or is not reported, and your answer is always on the 1099B. It's going to tell you whether it was reported or whether it's not. All right. So let's make sure we look out for that when we're looking at 1099Bs. Any questions on this?
Okay, yes, me.
Sure.
I'm sure I got it. So, all right, we put it. I've done it, but just I'm to know what I'm doing. That's where I'm at now. So short term is basically taxed higher at a higher rate because it's just short.
Yep,
So,
because it's less than 12 months.
Because it's less than 12 months, right? And normally short term is reported to the IRS.
Well, I'm not saying that it's normally reported. It will tell you whether it was reported or not. This just happened to look like this, but short term could not be reported as well.
Okay, so we always want to put the bias in.
The basis always goes in. You always put in the basis.
I'm sorry.
Yeah.
Okay, so we're putting the basis in, but especially for the one that is not reported.
Yeah, exactly. So you always want to put
for
it
long term.
Well, not just long term, but especially for when it says is not reported, because that means the IRS has no clue what you paid for something. If the IRS doesn't know what you paid for, they're going to make you pay taxes on the full proceeds, which you don't want. Like, for example, this short term, let's say this was not reported, they're going to try to make you pay taxes on $3,000.
Right.
I don't want to pay taxes on $3,000. I paid $2,700. This is my basis.
Right.
If it's not reported, even if it's not reported, I'm going to report it. I have clients where they've been taxed on their proceeds because their basis was not reported, and I have to amend their taxes and say, well, let's report the basis so you can pay less than what you paid before.
Okay, great. Thanks.
This is a 1099-C. This is a cancellation of debt. This is for like credit cards and stuff that you don't pay. You'll get a 1099-C saying, hey, you didn't pay this credit card off. We forgave it, but we're going to issue a 1099-C because now you have to treat it as income. So you'll get this from your Visa, Discover, whatever, and you got to report on your taxes. There is this rule where if I have more liabilities than assets, I may not have to report this, but that's a calculation that I need to go through. And when assets are talking about the value of your home, the value of your cars, the value of your retirement, like all of that is considered assets, how much money you got in your bank account. And liabilities be how much do you owe on your mortgage? How much do you owe on your car? How much do you owe in debt? If you owe more, if your debt is more than your assets, you're insolvent is what it's called. And that means you may not have to report this cancellation of debt. It's a rare thing that happens. But if somebody comes in and they're having some really financial woes, that person may qualify and they may not have to include this in their income.
Yeah, I had that once.
Yeah. So it's rare, but it happens. And then there's just some other less common income. We have gambling. Gambling may come in. I talked about the cancellation of debt. Those are probably, and there's like some other miscellaneous income. Maybe somebody won some money on like lottery tickets. They didn't get a W-2G issued to them, but they said, hey, I won some money on my lottery. I won $500. I can throw that in as a other income that they received, but there wasn't really a form that I got with it. All right. So that's what may go in there. Jury duty pay could be other income.
Okay. Real quickly, I just to go back before we get too far past it. When we were talking about the third payment, well, no, that's that month. Okay, no, not that.
You want to go back to the 1099K?
No, maybe it's not that. Maybe it's 1099 miscellaneous.
Okay.
So is that where money from inheritance is going to come in, or money from the selling of a family house that the people got a check and the kids split and they're bringing it to taxes? Like, is that something that they get or they bring it? Because I haven't seen anybody bring a miscellaneous in with that. They just bring like the letter from the lawyer or something.
So it depends. I think an
Or,
inheritance
should I just leave
may
that alone?
no, I mean that's definitely beyond the scope of VITA, but
Oh,
an inheritance is you probably would have like a trust might have been done, and there's some type of inheritance that's flown through from this thing, and you might get what's called a K1.
okay.
And they may bring the K1 in as their proof of how much they received from the inheritance of the sale of a house or whatever. But usually there's like an executor that kind of puts all this stuff together, and then they distribute it out to
Right.
the
Now,
recipients. And normally
who,
that's beyond our stuff, but you should get
right,
probably a K1 versus this 1099
1099.
That
miscellaneous. Yeah.
sounds familiar. I think someone did bring in a K1,
Right.
and
And
I think
we
we
want to
looked
be
it up and we
careful.
told them they was out of scope.
Yes, we want to be careful with K1s. That would definitely be. I mean, they have a K1 earnings underneath other income, but I
Mhm.
think that would be
Out of our
outside
scope.
of our scope. So we want to be careful with that.
Now, do they have to pay taxes on that money? Just
Oh yeah, they'll have to pay
okay.
taxes on it.
All right.
But it depends. I don't want to just say straight up yes. So
No. Yeah, I just was curious because I've just had people come with like just, oh, my mom, we sold the house, or just, different stuff. And I'm
yeah, it
like,
depends. Some of
oh,
the stuff is gains. It all depends on gains, or it depends on the type of income. So let's say I inherited I don't know, income from my dad's business. Like that may be earned income, and it's treated a
oh,
certain way versus I inherited the value of a house. Now that's treated as property, and that's treated as gain. So it just
oh,
it is
wow. So
you
they would actually
have
uh
to
tax
know
my money, inheritance money, as earned income from my parent that left it to me from the business.
if it all depends on the behavior of the income that I'm receiving. So if I'm receiving it from that is taking a place of um, earned income, then that's earned income to me. Am I getting it because I'm selling an asset? Then I treat it as an asset. I would treat it like I would do this 1099B stuff. Am I
Okay.
getting it as it all depends?
Yeah. Okay.
Whatever it was, it's flowing to me in that same
Way.
manner. But
Yeah. The same
so it
way.
always depends on what I might inherited. There's different type of ways of getting, and let me just say I am not an inheritance tax specialist, so I could
Okay.
totally be wrong, but that's my understanding of it.
All right. Cool.
It's a
Thank
different
you.
world. It's just like
Yeah.
somebody doing law and divorce, and then somebody
Right.
doing criminal. It's just
Yeah.
people
That's
doing
totally
different stuff.
different.
I don't know
Okay.
too much about inheritance tax.
Okay. Cool.
Um. All right, and then to kind of wrap some of this up, this is like a whole bunch of different types of taxable income. I have this in here really mainly to just always push home that unemployment compensation is taxable. Like a lot of people say unemployment is not taxable. They didn't know it was taxable. It is always taxable. There were certain years where they gave a little break and said a portion of it wasn't taxable, but it's taxable money. So it all depends. So
I
they
don't even
probably
understand how people can hear a question. Do you want to take taxes out of this money and think
right,
it's
and
not
a lot of people
taxable?
don't do it. It's definitely taxable. So yeah. So let me see. The inheritance is probably in here somewhere. Here it is down here. An inheritance is reported on isn't reported on the income tax return, but a distribution from inherited pension or annuity is subject. So that's what I was saying. The type it is. So if somebody had a pension that they inherited, then it's taxed because it was somebody's pension. It's taxed the same way, or somebody's annuity.
Okay. Yeah. That's just
So
like them bringing in their husband that it was left to
right,
them,
I got
retirement,
exactly. That would be an
or
example
this.
of that.
Okay. Oh, all right. Yeah. Oh, so
Um,
if it's just theirs. All right. That's cool.
So it may not be taxable. So it's saying some of it down here. So jury duty fees could be taxable, IRA distributions. But yeah, I wanted to really point out the unemployment and then some things that are not taxable, non-taxable income, child support. I like to point out that child support has nothing to do with taxes. And then even alimony that's after 2018, if you receive it, is no longer taxable. One of the good things, and you guys should be aware of the student loan forgiveness, you may see a lot of that. That's not taxable until 26. They made some rules where student loan forgiveness is not taxable. So that's a really good thing. And in here, it is to say, and some of this inheritance bequest is not taxable. So some of it is not, but it all depends, because up here, if it's alimony, if it's pension or annuity, it is taxable, but some other stuff is not. So it all depends on what you got going on. Welfare payments is not taxable, right? Certain workers' compensation is not taxable. All right. Any questions about any of that stuff before we jump into the scenarios?
No, I think I've asked them.
All right. All right, so let's jump into this. Victoria, anything?
When it comes to the 1099-B, you said that the short term is taxable at a higher rate than the long term, correct?
That is absolutely correct.
Okay. Just wanted to make sure that was right.
That's why it's important that we put in our date acquired and date sold correctly. Because if I made a mistake and put this long term in as like 2020, 9/17/2020, I would have made this $10,000 short term and made it taxed at a higher rate, which would be unfortunate. So that's why it's really important to put in good dates.
Right. Okay.
All right, so that's it. Let's go over some of these scenarios, the 6 scenarios. We'll do some polling questions just to make sure that we are understanding the concepts. If you guys are all on the same page, we'll keep it moving. If not, we'll just talk about it a little bit more to make sure that we are on the same page. We're in the 6744. We're going to start on page 68. We go through 68 through 73.
I'm sorry. Can I run to the restroom?
You sure? You know what? That's how about we take it's 6:56. Let's take a 5-minute break until 7 o'clock, and I'm just going to pause this recording.
Okay, thanks. Can you rewind it so I'm not asking? Can I go to?
I don't think I can do that.
All right, later.
All right, so let's jump into the scenarios. As I noted, 6744, pages 68 through 73 is the scenarios, and you can follow along with me. So the first scenario is about Chris's husband, George, who moved out of their home in February of 2022. She had no contact with him since he moved out. Chris and George are not legally separated. So Chris has one child, Mary, age 9. She would claim Mary as a dependent on her 2022 tax return. Chris is 31 years old. Chris earned $36,200 in wages, $50 of interest, and Chris was out of work for a month and received some unemployment income. Chris paid all the costs of keeping up her home, and she provided half the cost of support for Mary. They all have Social Security numbers or U.S. citizens, and they live in the U.S. all year. So the key thing to really look at here is that George moved out February 2022. So some of the things that you would have learned about in the basic one was trying to figure out, what can I claim? What could be my filing status, right? So first thing I need to determine is, do I have a dependent, right? And there's certain rules that have a dependent. So the child must have a relationship. So all up here is a relationship: son, daughter, stepchild, half brother, sister, blah, 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 blah. This is a relationship, right? The person must be under the age 19 at the end of the year, right? Or under the age 24 and a full-time student. Or they can be any age and be permanently and totally disabled. So if I look at this example, Chris had one child that was 9. That was her daughter. So they got the relationship, they got the age. The next thing they need to have is the child must have lived with them for more than half the year. The child lived with them all year, right? So they don't have to worry about that at all. The child must have not provided more than half of his or her own support. Chris did not provide more than her own support, right? Mary, the dependent, did not provide more than half their own support. And Mary's not married, right? This is the they filed a joint return. So they meet this test to be a qualifying child. So once I'm a qualifying child, I can figure out like, all right, well, maybe my filing status can be a certain thing. So I'm not single, I have a dependent. So I'm trying to see if I can be considered at a household. So was I married on the last day of the year? I actually was married, right? And so my answer would be yes, right? I will come over here. I was married. But then the key question is, did you and your spouse live apart for the last 6 months of the year? And they did. So now I can go down here and see if I can qualify for head of household. To qualify for head of household, I would have to, I'm filing separate from my spouse. I paid more than half the cost of keeping up the home for a certain time, right? And the house is the main home for a child or stepchild. That would be Mary. Mary's my child. So I qualify for head of household because I maintain all of this and I'm going to claim that child. So now I'm head of household. If I was to do this and look at George, who moved out the house, George would come over here and try to do head of household. George would say, was I married on the last day of the year? Yes, I was. Did you and your spouse live apart all the last 6 months of the year? Yes. And then it would say, well, did you pay more than half the cost of keeping up the home for someone? His answer would be no. And he would have to file Mary filing separately because he didn't have that child in his household. So over here, Chris is head of household. George would be Mary filing separately. All right. The other thing here is EITC. So rules for everyone for EITC. Taxpayer must, sure.
Wouldn't one of their returns reject because they're filing different? Because one is filing Mary, filing separate. Like say if he filed before she does, and she go to file head of household, isn't her return going to reject because her husband did Mary filing jointly?
Mary filing separately, it would not reject because she qualifies to, it's called considered married. So she's considered married, but she can file as head of household because she met these guidelines to be head of household. So it's not going to reject for her at all. Even if he puts down her social security number when he does his married filing separately, it won't reject hers at all.
Okay, so to piggyback off of that, excuse me. So being said that if they both were, let's say Mary wasn't in it and she filed single and he filed separately, then they would
so then that would be a different situation. It wouldn't reject, but I think it could show it. I don't think it creates a rejection no matter what. But what I think it
used to, yeah.
Well, maybe. I mean, I don't think it did. I think it actually is more of a red flag to the IRS that one person is saying they're married and the other person is not. So the head of household thing is just you can bypass filing as married filing separately, but I don't think it should reject it. It's just the IRS will say, well, why is one person using the social security of somebody else? Why are they doing it?
No, I'm not saying that scenario. I get that one can be married filing separate and the other one head of household because the child lives with them. I get that one. But let's say they're separated and one is still filing separately and the other one is trying to file single. That with no child, Mary's out the picture. With no dependents. That will reject.
I'm not sure if that's has it done that? I have not seen that, but you probably have done it more than I have seen.
It has rejected because of that. It is, and it'll come up saying a spouse has filed differently.
Oh, because and it is that social security number that's making it happen. So what's happening is maybe the rejection is because you're saying single. Yeah. So if you said had a household, it wouldn't reject it versus saying single. Okay. I'm sorry. Okay. I didn't know that was a thing. And what I'm saying though, that social security number makes that happen. So the social security number is in the system as being on somebody else's tax return as that other spouse with their social security number. So when I go single, the system must say, well, if you don't say head of household and you say single, then I'm going to reject it because you should be filing married filing separate as well. Right.
Or they have to mail it in as paper.
Right. Okay.
All right.
So when it comes to EIC is kind of a subset rules in there saying, all right, the taxpayer can't file as married filing separately. So that would eliminate George there anyway, right? Because he's filing married filing separately. So he couldn't get EIC. She's filing head of household now. So now she can get EIC. So she's not filing married filing separately. The qualifying person, everybody got to have a social security number. So everybody has social security numbers in this scenario. They're all U.S. citizens, and I don't have to worry about investment income. They didn't have more than 10,300. So the rules for everyone they meet. Now, do I have a qualifying child? I have a child that meets the relationship, the age, the residency, live with me, and they did not file a joint return. So they met that test as well. And they're good because they met the rules for if you have a child. There's also rules if you don't have a child, and you need to be aware that it changed from last year. Last year, the age was at 19. They now brought it back to what it was pre-COVID, where it needs to be 25. And then it ends at 65 or 64. So it's under age 65. Last year, it was just like 19 and over. So people that were older got EITC that never got it in the past. So that was exciting for them. But now people that are older are not going to be able to do it. Older as in being over 64. And then these are the increments, right? So you have income for when you're not married and income for when you are married. So head of household or single would be out here, and then married filing jointly would be in here. Cool.
Cool.
So that's EITC. Again, this is just examples of just taxable income. I actually do not need this slide to be here, so I may remove it. I don't know why. Oh, I think I know why this is here. This is in here. Let's see. Unemployment. They said something about unemployment income of $1,800. This is in here to just remind folks that unemployment income is taxable income. All right, so they do want to definitely include that. All right, let's do some polling questions on this one. I launched the poll, and there you go. There's your first polling question. And I want to make sure, Mir, can you see that? I know you're on your phone. I'm not sure if you're able to see the
Yes, I'm
poll.
sorry. I can see it. I was trying to take the poll and I was like, wait a minute, let me jump back. Yes, I can see it.
Okay, go ahead.
Yeah. Okay, now I need to get back to it.
Because I know, I think if you're on your phone, I'm pretty sure it's weirdly coming through for you.
Yeah.
If it's a challenge, let me know and you can just blurt it out.
Well, it was on the screen, but then when I went to start talking to you, it went off. Could you send it to me again? If I don't know if that's how you sent it.
Let me go. Sent to everyone. No, let me try it one more time. Let's do this. I am going to relaunch the poll. All right, everybody just try it one more time. Let's go. There we go. That worked out for everybody. I'm gonna end the poll, share the results, and just want to say we're all on the same page. All right, so that sounds good. Let's move on to the next poll, the next scenario. All right. So the next scenario is, oh, wait. You know what? There was two questions to that one scenario. Let me ask the second question. Actually, there was a couple questions. My bad. There's another question there. All right, so I'm going to end the poll, and I have answers all across the board, right? So I want to make sure we're on the same page. So the question is about Chris. Does Chris qualify for earning credit? So Chris is the person that's filing his head of household. George is the spouse, to make sure we know who is who. So Chris has a dependent in the household, right? Chris is married. George left, so the spouse was in the house last 6 months of the year. So they're the head of household. And then they want to know, okay, well, do I have a child? Do I qualify for EITC? I need to have a social security number. I am not filing married, filing separately. So Chris is filing at a
I'm
household.
sorry. Yeah, I don't know why I read Chris as George. That's why
I think that was, I've seen people I thought that was
I was like, wait, I think I just read George because we already asked about Chris. I'm sorry.
Right.
That was my fault.
Yep. You also said that the
too
child
bad.
meet the relationship, age, residency, and they not file a joint return. All right. So that's how you can determine about EIC. Let's stop sharing. I'm going to relaunch that poll and make sure that we're all on the same page real quick. All right, it looks like we are all on the same page. I'm gonna share the results. Thank you. And let's do one more. There was one more question for scenario 1. What amount of Chris unemployment compensation is taxable? And he received $1,800 of unemployment, so you know that's how much he received. How much of his unemployment is taxable?
That's why I keep thinking George is, I think you're talking about the man because you keep calling Chris a he. Isn't Chris the man?
Oh, yeah, Chris is a female. You're absolutely right.
I'm like, wait, that's because it just like it made me look at George.
Right. It's funny because when I started reading it, I did think it was a male until it said she was able to claim Mary. All right, so we're all on the same page there for scenario 1. I'm going to stop sharing and we're going to move on to the next one. All right, scenario 2. We have Adam and Lisa Garcia. Any questions on scenario 1? We all good there?
Yeah.
No,
right.
I'm good.
Okay.
All right, cool. All right, Adam and Lisa Garcia, they're married. They want to file a joint return. So that's simple. I know what their filing status is. Adam is a U.S. citizen, and Lisa, though, is a resident alien and has an I-10. So Lisa doesn't have a social security number. They both reside in the United States all year with their children. Adam and Lisa have 2 children. Their ages 11 and 17. Marie and Louise are U.S. citizens and have social security number. Adam earned $22,000 in wages. Lisa earned $20,000 in wages. In order to work, the Garcias paid $2,000 to their son, Louise, to care for Maria after school. So they paid the money to their son to care for Maria after school. All right, Adam and Lisa provided all the support for their 2 children. Test to be a qualifying child, must be relationship, right? Got to be related to me. They must be under the age 19 or under the age 24 and a full-time student. They got that. The child must have lived with them for more than half the year.
They have that.
The child must have provided more than half of his or her own support, must not have. So they were supported by their parents. So looks like they have qualifying children. That's a no-brainer. Filing status is simple as were you married on the last day of the year? Yes. Do you want to file? Do you and your spouse live apart? No. So they can file jointly or separately. Jointly is the most advantageous, and so they're going to file jointly. EIC, the rules for everyone. The taxpayer and qualifying children must all have social security number. Did that happen?
No.
I'm done here. Right? That's the rules for everyone.
Wait, taxpayers and qualifying. Oh, okay.
Taxpayer and qualifying children must all have social security number. If that doesn't happen, I'm done.
Okay.
Yep.
All right. No EIC.
No EIC. Stop. How about child tax credit? The rule is you got to be under the age 17. Do they have a child under age 17?
Yes, they do.
Yeah, they do, right? They got a child under age 17. Is the child a U.S. citizen?
No.
Yes.
One in
yes
and no.
Is the child a U.S. citizen? Is the child Maria? It says Maria.
Yes.
And Lisa
Maria
have
and
2
Louise
children.
are U.S. citizens.
So they are both
I'm
US
sorry, they have
citizens.
2. They're both citizens.
And they have social security numbers, right? So, yep. Can I claim them?
Yes.
That was up here when I did this thing. Can I claim them?
Yes.
Yep. So I can claim them. And is it my son or daughter?
Yes.
Yep. They didn't provide half of their own support, right?
Right.
No.
And they lived with the taxpayer for more than half the year.
Yes, they did.
And did they have social security numbers?
Yes.
Yep. So there's only one person that was under the age 17, right? So that person made them a qualifying child for child tax credit. That makes sense? This is the rule for child tax credit. That person is similar to the dependency rule. The only difference is that it has to be under the age 17 instead of under the age 19. So it's a little bit younger. And the child must have a social security number.
Gotcha.
So that's one of the differences. All right.
Okay.
And then there's another credit for other dependents. And these are for people that don't qualify for child tax credit. So that could be somebody that is 17 and above. Is there a kid that's 17 and above?
Yes.
The wife.
Louise, the son.
The wife is not a dependent. The wife is just a married person. They're not a dependent. So Louise is age 17.
Okay.
So Louise is somebody that can't get child tax credit, but they can get the other dependent credit.
Oh.
And that's 17 and above.
Okay.
So the difference between the two is this one is a credit up to $2,000. So I can get a credit. So what a credit does is reduce your taxable liability. So let's say I made $10,000, and on that $10,000, they want to tax me, let's say $3,000. Just made that up. They want to tax me $3,000. So now I owe the IRS $3,000. What I can do with this is say I have one qualifying child. I'm going to get a credit for $2,000. Now instead of owing $3,000, I owe $1,000, right? And I said, you know what? I got another person, but I only get a $500 credit for this person. So now I'm gonna take another $500 away. So now I owe $500. Does that make sense? That's what credit does. Credits kind of reduce your liability.
Tax liability.
So let's give you another example. Let's say this person tax liability was $1,000 and they had a $2,000 child tax credit. So the $2,000 child tax credit is more than $1,000 of tax liability. So with a child tax credit, I can use a portion of it to be refunded to me. So I can't use the full $2,000. I can use up to what's it's called $1,500. It's called an advanced child tax credit. Not advanced. It's called an additional child tax credit. So instead of using $2,000, I'll be able to use $1,500, and I would get a refund of $500 if my tax liability was only $1,000. Because $1,000 would wipe away the tax liability, and it'll give me back $500. They won't give me back the full $1,000 because the rule is after you exceed your tax liability, you only can get up to $1,500 of child tax credit. Does that make sense?
Okay, so let's say let's say their tax liability goes over, they only owe $2. They lose $500 because of that?
That is correct. They'll get a $1,500, they'll get $1,498 as a refund.
Okay, so out of the $2,000, they're only going to get $1,500.
If they exceed their liability, they can't as a refund. Out of the $2,000, they can only ever get more as $1,500 as a refund if they don't have tax liability.
Okay.
They won't give them the full $2,000. In prior years, like last year, they made it all refundable, so you could get the full $2,000 back. This year, they're only letting you get $1,500 of it back. You only can use the full $2,000 if your tax liability is more than $2,000. So if I owe $3,000, I can use a $2,000 credit to get rid of $2,000 of it, and then I would owe $1,000 left. But if I owe $1,000, I can use $1,000 to wipe away that tax liability, and it'll give me $500 as a refund because I only can get $1,500.
All right, I got you.
Now, this is because this additional child tax credit has $1,500 refundable piece in it. The other dependent credit, this doesn't have a refundable piece. So let's say that I owe $100 and I got $500 other dependent credit. I don't get that refunded. I won't owe that $100, but I won't get a kickback of that $400. It will go away.
Okay.
So that $500 credit will just wipe away the 100 and I'm done. I won't get nothing refunded to me because this is what's called a non, and they has it down here. This is what's called a non-refundable credit. Wow.
But it is if you like getting a refund or when you cover your tax liability, you do get that 500.
You get that 500. If I had $600 of tax liability and $500 of a credit, I'll now owe $100. They'll give me the full 500 there, but they won't give me any more than my tax liability.
Right, but I'm saying if you don't have a tax liability and you're getting a small refund, you don't get the 500 for your.
Exactly, you do not get the 500.
Oh shucks! So you only get the 500 this credit just to pay a tax liability.
Exactly, it's a non-refundable credit.
But can the debt be 500? Because you said 600. If the debt is only 500, I'll get the $500 credit.
Yep, and I will owe zero.
Just pay it off.
Yep, okay. It would be if I had $500 of tax liability, I would get a $500 credit, and now I will owe zero.
Okay.
Up here, this is the part of the credit isn't refundable, and that's why it says $1,500 because $500 of it isn't refundable. So this works just a little bit differently. So like most of it is, but not all of it. All right. Are we clear about this?
Yes.
The big thing is this is for somebody that's 17 and above is non-refundable. Right. This is for somebody that's under the age 17 and 1,500 of it can be refundable, not the full 2,000. Okay. Refundable only comes in play when I wipe away my tax liability. Okay. When I don't have it, when I don't owe any tax liability, then I know, all right, I'm limited to $1,500. When I do have tax liability that's over 2,000, I can use all of it.
Okay.
So that's basically, I'm telling you this, that's how credits work. Credits reduce your tax liability. Some credits, like earned income tax credit, like a portion of the child tax credit, some of it is refundable. So you'll get it whether you have tax liability or not. Credit for other dependent is a non-refundable credit, and so is child and dependent care credit. Child and dependent care credit is a non-refundable credit as well. So for child and dependent care credit, it's pretty straightforward. You got to be working, right? You both parents got to be working. So if you're married, you both got to be working. The child must be under the age of 13. So how old was this kid? This kid was 11. So Maria was age 11. Under the age 13 when expenses occur. So they were under the age 13. You got to live with the person for half the year, and I need to be working. All right, I definitely need to be working. I say this because there's times where a married couple and one of them are not working. And they saying, oh, why don't I get why don't I get the child tax credit? And you don't get a child tax credit because one of them wasn't working and they don't understand that. But that's just the IRS rules. You have to both be working.
Right. Because the IRS is saying, oh, somebody's home, they could be watching that baby.
There you go. Right. Somebody is home. Why? Right. Why are we here? Why am I giving you a credit for something? Because you could have been somebody could have been at home paying for this.
And now does that only go for a parent, for the taxpayer, married filing jointly?
It would go, I mean, so if I was, let's say if I
They're not going to say it's a child, like would they, because let's say you have that 22-year-old that's not in school and you're just getting that additional 500 dependent care, would they consider that person supposed to be home to watch that child?
Say that one more time.
Okay. Does that rule just go for the taxpayer being a husband and a wife? If the wife isn't working, are they just looking at her as watching that child? They're not looking at a dependent of their 22-year-old son that they claim, and he's still in the house not working because he's a dependent, maybe?
So
say,
I think I know what you're asking, and I think I'm gonna answer your question.
Okay.
If I can't pay someone who I claim as a dependent childcare expenses and get credit for it, is that what you're asking?
No, I was saying, does that just pertain to a husband and a wife, married filing jointly? If there's a dependent and one is not working, the IRS considers that person could be watching the child, so they're not going to pay that credit.
That is correct.
Now, does that also go for if I have, let's say it's just a single person, and I have a son that's 24 or 23, but he's not a student, he's not in school, he's in home and not working, would they still pay my child care? Because
if you're working as that single person,
because
yes.
Yeah, because he's a dependent. It's just for the taxpayer.
Right. It's only for the taxpayer and the spouse. That is correct.
Right.
That is
that's
correct.
that's what I was asking. Okay.
Yeah. So I want to make sure we do understand that I can't make payments to someone who I'm claiming as a dependent either. So let's be careful with this example, right? So who do they make the payments to?
Louise. Oh, so that's where I was going.
Who's Louise?
Their son. Okay.
So can Louise be claimed?
Yeah, as another dependent.
Right. Louise can be complained. Well, let's be careful with on our language. Louise is a regular dependent. Remember, dependent is under age 19.
Oh.
So he's a qualifying child as dependent. What he get is an other dependent credit, but he's a regular dependent. He's a
regular dependent, but because of his age, he's going to get other dependents.
Exactly. There we go. That's how we use. That's the language. That's the right language.
Term. Okay.
Right. So they're all dependents. They're both dependents.
Right.
One just is getting a certain credit. One is getting a child tax credit. One is getting the other dependent credit. But they're no matter what, they're both qualifying dependents. So the fact that Louise is a dependent, the money that was paid to him does not qualify for child tax credit because that's a dependent. Now, if that wasn't their dependent, that's a different conversation, but it is. We good?
Yes.
Any questions on that? So let me just, because I don't think I actually, and I'm going to share these slides eventually, but I want to pull this up, and especially because I'm recording. In your 4012, there is a screening sheet. So here I could ask questions to see if I can get through this. So was the care for one or more qualifying person? Yes, go to step 2. Did you have earned income? Yes, go to step 3. Did you pay the expenses to allow you to work? Yes, go to step 4. Were your payments made to someone you or your spouse could claim as a dependent? Yes, you can't claim the dependent care.
Okay.
So that's like if you wanted to go through this using a 4012 as a resource, it gets you to the answer. All right.
Yeah.
Remember, this was paid to someone who they could, and this is on G10, probably G10. So on my resources, I have G9, but it's on G10 to get that other part. I might need to add G9, G10 here. All right. Any questions about any of this? Y'all ready for some polling questions? All right. Let's see here. Let's do polling question. What is the maximum amount Adam and Lisa are eligible to claim for the child tax credit? Think about how many kids can qualify for child tax credit, and make sure we know how much you could get. How much are they eligible to claim? How much they will receive will depend on their tax liability and stuff, but how much are they eligible? I got one response. I'm looking for 2 more. I got 2 responses. I'm looking for 1 more. Let me know if anybody's having any issues, just let me know. And if you're not sure, that's fine. You don't have to even say who it is, and I can talk about it a little bit more. I'm looking for 1 more response. If somebody's having technical difficulties, let me know so we can move on. Anybody? I'm getting 2 out of 3 responses. Is anybody not able to respond? Hello?
I responded.
All right, so that might be Mia. You good, Mia? Was it Mia? Yeah, I think she might have some issues. Okay, I'm going to end the poll, and we're on the same page, so we're good to go. All right. When she gets back on, she can say something. This is another one. The Garcias qualify for the child and dependent care credit. Do they? Is it true or false? Do they qualify for the dependent care credit, the child and dependent care credit? That's that daycare one. I got one answer, just looking for one more. Do they qualify for the child and dependent care credit? All right, I'm going to end poll and share results. I got mixed reviews. So I just want to go back and make sure we understand the child and dependent care credit. Child and dependent care credit would be for someone who is working and their children are under the age 13 who they put into childcare. They'll be able to get this dependent care credit if they were working and they didn't pay the money to someone else that they're claiming. So if I look at this one, traditionally you pay the money to a daycare center, right? And you go to work, you pay the daycare center, and that's qualifying expenses. But if I pay it to somebody that I'm claiming in my household, that person is ineligible. That's the ineligible person that I can pay to get this credit for. So I paid it to my son, who is also my dependent. They're saying that's something you can't do, right? In order to work, I paid it to my son. Now, if I said I paid it to my daycare center or I paid it to my 26-year-old niece that came over to come watch the kid, that's a different story. That I don't claim my niece. I clearly claim my son, all right? Louise is a dependent. We good? It said Adam and Lisa provided all the support for their 2 children.
Yes, that was my fault. I wasn't thinking, and you did just go over that, and I wasn't.
It's all good.
So that was my fault.
That's cool.
I put true.
We on the same page now, and I ain't mad at it. So that's cool. Let's move on to the next one. And that was it. It was only 2 questions for scenario 2. So we good, Victoria. If we're on the same page, I'll move on to scenario 3. Let's see what we got. Scenario 3. So here we're talking a little bit about HSA. So we're going to switch gears, change your thinking a little bit. We're going to talk a little bit about HSAs. So we have Jenny Smith, who's 57 years old and single, and Jenny earned wages of $52,000 and was enrolled in this high deductible healthcare plan, right? She was only covered for herself. During the year, Jenny contributed $2,000 to the health savings account, and her mother also contributed $1,000 to the HSA. Jenny has a W-2 that shows $650 in box 12 with a code W. She has a 5498 SA showing $36.50 in box 2. And then it says Jenny took some distributions, and we'll talk about what qualifies. So I want to just pause real quick to make sure we understand just some of the basics. An HSA is basically, look at it as an IRA. It's like money I can put away into that can earn money. I can put it into like this interest-bearing account, or it can grow. But the way that I use my HSA is strictly for health stuff, right? And there's like a list of all kinds of health stuff that you can use it for, which is here. I can use it, bandages, birth control, basically a lot of the basic things that people use medical expenses for that is from their doctor. You can also use it for like over-the-counter stuff, for like tampons, for like over-the-counter medicine. You can also use it for that. You can't do that like when you itemize, but you can do that when it comes to HSAs. So it's kind of the basic medical expenses in addition to some over-the-counter and menstrual care products. I can use that for HSA. Now, The amount that I can contribute in a plan depends on whether I'm a self-only plan or if I'm a family plan. So somebody that is just by themselves, they can put $36.50 in there. Somebody that is in a family, they can do twice as much, right? The plan must be a high deductible healthcare plan. If I at a certain age, which is 55, I can add an additional $1,000. So I can put $46.50 in if I was only by myself, or $8,300 if I was with a family, right? Now, how can I contribute to an HSA? Anybody can contribute to your HSA. Your employer can do it. You can do it. Your mom can do it. Your dad can do it. Your brother can do it. Anybody can contribute to your HSA. All right. Just know that your contribution limits are at a certain amount. So as a self-only person, she cannot have more than $36.50 in contributions. So let's go back to up here. She had $2,000 that she contributed, right? She had $1,000 that her mom contributed, and her employer put in $650. And we know that it says on her W-2. So if you ever look at a W-2 and there's like a box W, and this shows this is telling me how much the employer put in. All right. So the employer, this one would have said $650. So the total contributions that was put in for this person is $36.50. Did she reach her limit? Can she put in more?
Yeah.
She can. And
Yeah,
why can't she put in more?
Because she's
because she's over 55.
Yeah, thank you. You guys caught that. Right. So she's 57. So she can actually still put in another $1,000 if she wanted to. But she only did 2,000 for herself, 2,000 from herself, $1,000 from her mom, and her job put in $650. So that's $36.50. So when I look at the $54.98, the total contributions made in 2021, what's it going to say?
3,600. Wait, the total?
36.50.
36.50. I'm sorry.
Right. Yep. Because that's the total amount that was put in.
No, I don't know why I said that. I'm dyslexic.
No, you just forgot the 50. You're good.
Yeah.
So that's so this is what they're talking about. The 54.98 is going to say this is the total amount of contributions that was made.
Mm-hmm.
And that's all the 54.98 is really telling me. How much money was put into this HSA account? We good?
Yes.
All right. So let's keep going down. So then it says this. So that whole section, all this stuff up here, and the 54.98, all this stuff here, that's contributions. That's me putting money in. Now, what we're going to talk about is distributions. This is distributions. Distributions, me taking the money out. Mm-hmm. So now I need to understand that I only can take it out for qualified medical reasons. So 8 visits to a physical therapist after knee surgery for $400. Do you think that qualifies?
Yes.
Yeah, that qualifies. How about some unreimbursed doctor bills?
Yes.
Yes. How about prescription medicine?
Mm-hmm. Yes.
Yes. What about replacement of a crown?
The crown on her tooth, right?
Yes.
Yeah, I would believe so. Yes.
Yep. And over-the-counter medication?
Yes.
For HSA, that's a yes. Now, if that was for an itemization, that would be a no. But for HSA, that's a yes. The gym membership, what about that one?
Did they change the rule?
The gym membership would be a no. Unless,
so what if it's for health purposes?
Unless their doctor required it.
Okay.
So this would need a doctor note to do this one. Okay. But at face value, this would be a no. So for their distributions, they would get 400, 900, what is that? 1,300 plus the 200, that's 1,500 plus another 1,500, that's 3,000. So they'll get 3,040 of distributions. Does that make sense?
Mm-hmm.
So on their 1099 SA, their distributions would say that $3,040. So in here, I'll see 3,040. Does that make sense?
Yeah.
So what if this said $4,000 in distributions. Matter of fact, what if it
only
said
3040 would be covered?
It said it's 3,040. What if they included this 240? So what if it said 3,280 in distribution?
32.
Yeah, because I'm adding in the $240. I'm gonna add the 240 and say now that it's $3,280. I'm adding basically all of this to it. Let's say this said $3,280. This would tell me, and I end up, and they're sitting down with me, and I'm going over their break over, and I'm saying, you know what? You actually only have 3,040, but your distribution thing says 3,280 because they included something they shouldn't.
Right.
So you know what? That's a problem. You're going to get taxed on that. You're going to have to take that out because what you're going to get is, let me see if I can show it on the 8889. Is it on here?
Okay.
It is an additional 20% tax right here.
Oh, wow.
Any money that I take out that was not for a qualified HSA distribution, I'm going to pay a 20% tax on that until I put it back in.
Oh, okay.
All right. So you want to make sure this is rare. Like when we talk to our clients, 9 times out of 10, everything was taken out for medical reasons. But sometimes somebody's talking and they're like, say something that reveals that it wasn't the case. It's like, ooh, that don't qualify. Right.
Oh, so that as well is like cash income. It's one of those they definitely have to report it because they wouldn't know what it was actually spent on.
Right. We don't because you know what we're going to get this thing that says, oh, you look like you took out $80. Right. Then I'm gonna say, all right, what did you use the $80 for? And was it so what our question is, was it for health purposes? And somebody could say, you know what, I took $80 out because I was broke. I needed to like live. And I'm like, ooh, that's a problem. You're gonna pay a penalty on that. But most people say, yeah, I took it out. I had to buy some aspirins and that's what it was for. I buy aspirins every month. You know what I mean? And that was my $80. So you have to at least ask the question. But this 1099 SSA is for distributions, while this 5498 SA is for contributions. And money I put in.
Now, just for the tax layer purposes, do we have to put in that 5498 in the system?
So, that's a good question. Is
like for what we do, because I know it's distributions. They, they've been, I just want to know that. Do we have to input that?
So if I'm not mistaken, for tax layer, and let's talk about this more in advance too when we're in the system. Okay. I believe so. You put in what you and your mom put in, like in this situation, you would put in just the 2,000 and 1,000. You put in the 3,000 because if you did the W-2 right, it's going to show that the 12, employer put in 650. You would not add that in there. So let me see if I can show you. So here's the 8889. So this is what you're filling out in tax layer. So it says here, the HSA contributions that you made in 2022 do not include the employer contributions. So in here, I would put in my mom and my stuff.
The 3,000.
The 3,000. And somewhere in here would show what the employer put in. So the beauty of an HSA is when I make those contributions, I can treat it as a deduction on my taxes, meaning that $3,000 I put in, I can deduct it on my taxes as an adjustment. I can reduce my income by that $3,000 of contributions. Mind you, I can only do the deduction for the 3,000, which was the 2,000 I put in and 1,000 my parent put in, but I can't do a deduction for the 650 because my employer put it in.
Right.
So my deduction would be 3,000, but remember my total contribution was 3,650. But I only can get a deduction for what me and my parent put in, not what my employer put in. So when I fill out this 8889, up top, I'm only saying 3,000. That's what I put in. And then by the time you get down here, the 3,000 would be your deduction. And my distribution would be all the qualifying HSA stuff. And then it says, well, how much of it was qualifying expenses? of that, this is how much was qualifying. And usually there's a 0 for which you got to pay taxes on. But if somebody say, I took out 100, I used 10 of it for prescription and I pocket the rest, then I'm paying taxes on that $90 bucks. But I didn't use it right. That's rare, but that's what this 88.99 flow is basically trying to help point out.
Number 13, HSA deductions, is that automatically put on here, or because we put in
the 3,000 up here?
The 30, 40?
Yes, exactly. So not 30, 40. The contribution was 3,000. That was the 2,000 that Jenny put in.
I thought 13 said distribution.
No. 13 said deduction.
So that's why.
Let's be careful. So
I'm reading
part
wrong.
1 is contributions. Part 2 is distribution. A deduction and a distribution are 2 different things.
Okay. See, when I looked at 13, I looked at deduction as distribution.
Right.
All right. And that's down in part 2. All right.
So I hope I'm not about to confuse you, but a deduction is equal to the amount of contributions you put in, that your parent and you put in, not your employer. The distribution is the amount of money that you took out of your retirement plan and used it to pay for medical expenses.
Gotcha.
We good?
So quick question, only because I was trying to read real quick. So when it says the smaller of line 2 or 12, line 2 would be your contributions, your family, whoever with you. So all of this from line 11 and then is up from line is that going back to that would determine whether some of your job contributions would affect that line 13?
Yep, it's a bunch of other stuff. It's like your job. There's like this Archer medical spending account. It's like all this other stuff, right?
Okay.
Yeah.
Right, there we go.
Yep. I would say 9 times out of 10 is just going to default to line 2.
Right.
That's what you put in. All right.
13 is HSA deductions.
But this is what's happening behind the scenes. This 88 to 89 form is being filled out behind the scenes.
Okay.
All right. So some key takeaways. Again, the 1099 SSA is how much money I took out of this HSA. And I need to ask the question, of the money you took out, was it all used for qualified medical reasons, which is all this stuff here, right? And then here is how much money that I put in, right? And this would be the total contributions from me, my mom, and my employer. This is the total amount I put in, and I cannot exceed my limits. My limits for a self-only plan is $3,650. My limits for a family plan is $7,300. If I'm over the age 55, I get an extra $1,000 bucks. Cool?
Yeah.
All right.
Yes.
So was there a question?
Oh, no, I was saying yes to your answer.
Awesome. All right, let's do some polling questions. All right, so, and I'm going to put this back on the screen, the 88,
I was about
89.
to say, can I see it? Oh, yeah, I need the page.
So it says part 1, and part 1 is up here where we're talking about HSA contributions and deduction. It says, is used to report HSA contributions made by who? Part 1. So in here you have made by those made by you or other people. In here they talk about employer contributions up here. In here they talk about Archer MSAs. So part 1 is just contributions from any source. So just don't get caught up on what I was talking about, what qualifies as a deduction. Part 1 is basically capturing all contributions that was put into this account. So whether it's the parent, whether it's the mom, the dad, there's me, the employer, this is who put money in. The deduction will net out like the employer stuff and take that out. All right. But part 1 is saying how much contributions were made. All right.
So that would be everyone.
That would be everyone. All right. So let's do the next question. Jenny is eligible to contribute an additional 1,000 to her HSA because she is 55 or older. Is that true or false? So you guys can answer that poll based off our conversation. All right, we on the same page there. Awesome, awesome, good job. And then the last question in that scenario is asking about part 2. So part 2 is distributions. What is the total unreimbursed qualified medical expenses? What was the qualified amount? And that's going to be the total of what we determined what was qualified. Remember the math. Don't forget this $40 down here. All right, I think somebody just forgot the $40.
Yep, that was me.
Yep, no worries, no worries, no worries. So don't forget to add, the only thing that didn't count was the gym membership. All right. Yeah. All right, any questions around HSA? That was kind of our HSA lesson. Any questions around this?
No.
No.
We good? We sure?
Oh yeah, you broke it down really. It makes it easier and you simplified it.
All right, all right, cool. All right, let's move on to scenario 4 then. All right, so we have Alice, who's 58, single. She owns her own home and provides all the costs of keeping up her home. Linda, who's age 24. Hello?
Uh-huh.
I don't know what, it's a recording in progress. I don't know what happened. It said, Alice, age 58, she's single, she owns her own home and provided the cost of keeping up her home for the entire year. Her income was $46,000. So Linda, who was 24, and her daughter Nancy, age 4, moved in with Linda's mother, Alice. So let's just break this down. Linda is Alice's kid, and then Nancy is Alice's granddaughter, and of course, her daughter's child, right? Okay. Alice, so Linda moved in with Nancy, and they moved in with, Linda moved in with Alice after she separated from her spouse. So Linda and her kid moved in with her mom after she left her husband, all right? Linda's only income in 2022 was $25,000 in wages. Linda provided over half her own support. Nancy, which is the 4-year-old, did not provide more than half of her own support. It doesn't say who supported her. It just says that Nancy did not provide half of her own support. Linda will not file a joint return with her spouse. All people in this household, as individual in the household, as U.S. citizens with Social Security numbers, no one is disabled. They all live in the United States all year. So let's kind of break this down because there's a lot of moving parts here. If I think about Alice, does Alice have a dependent in her household?
Yes.
So who would be Alice's dependent?
Nancy.
Granddaughter?
Her granddaughter could potentially be her dependent.
Potentially.
Mm-hmm.
Right. Let's throw that word out there, potentially,
yeah,
right?
Mm-hmm.
So Alice could potentially have, so how about Linda? Could Linda be her dependent?
No,
because she provided more than half her own support.
And she's 24.
That too.
She's 24, so she's over the age 19 and she's not in school. And that killed her right there. The fact that she's 24 and not in school, she's not my dependent. And she made more than $25,000 because if I wanted to see if she was a qualified relative, her income has to be less than $4,400. Right. So that's not a dependent, but yes, potentially Nancy could have been a dependent. So let's keep that in mind. All right, let's think about Linda. What is Linda? Does Linda have a qualifying child?
Yes.
Mm-hmm.
Correct. Linda potentially has a qualifying child, and Nancy as well, right? Because Nancy did not support herself. Nancy meets the relationship test, the age test, lived with her for more than half the year, and did provide her own support, right? Same thing happened with Alice. So they both have a potential dependent. We good with that?
Correct.
All right, let's think about who dependent it would be. So we look at what's called a tiebreaker rule. Here is the most simplified way of saying this. This right here. If only one person is the child's parent, the child is treated as the qualifying child of that parent. If you ever come across a scenario of grandmoms and whatever fighting over, the tiebreaker is who's the parent. That's the IRS law tiebreaker. So no matter what they get, what they say, it goes to the parent. Now,
Let me ask you a question. It goes to the parent, but which parent?
But hear me out, the parent.
Oh,
the child's parent. So the grandparent is not the child's parent.
Correct.
They're the grandparent. Now, if it was a actual parent, like a dad and a mom arguing over it, then the conversation goes to income. Whoever has the largest, the higher income. So then you go down here, it says, if the child lived with each parent for the same amount of time, then we go to the highest AGI, whoever made the most money. Like if they're arguing, so you got two, non-married folks living in a household, they got a kid and they're arguing over who's going to claim them. The person would say, well, I made the most money, I'm claiming this kid. And the IRS likes that too, right? Because the more money I make, the less credits I'm going to get, right? So that's what it would go to the highest one. But for the person that has that grandparent, it goes to the actual parent, not the grandparent, the actual child parent. They get first dibs. Now, the child parent doesn't have to do it, but they get first dibs.
Okay, now let me ask you a question. It's probably in there, but I didn't remember seeing it. So the daughter, she got divorced, but was she living with her husband the first part of the year?
She could have, but she was only living with them for 4 months, I think it said, right?
It said till April, yeah.
Right. So this child was in a household for more than half of the year with both of them.
I got you. Okay.
Yeah. So now let's think about filing statuses, right? What would be Alice's, the mother, the grandmom, filing status?
Head of household?
Single. She don't have no dependents. She has to have dependents for her
It
to
would
be head of household.
It would depend.
Yeah,
if she claimed the grandchild,
if
then
she
she
claimed
would be head of household.
Yeah.
Well, let's talk about it.
Oh wait, yeah.
Let's talk about it.
Household without claiming her daughter.
Let's talk about it. Let's talk about it. So let's be Alice. Was Alice married on the last day of the year?
No.
No. Did her spouse die?
Not that we're aware of.
No. So we don't have to worry about any of that. So did she take care of half of the cost of her household?
Yes, she did.
Wait. You said was Alice married on the last day of the year?
Right.
It just says Alice after she separated from her spouse.
No. Alice was single. Alice is 58 and single. You're talking about Linda.
Talking about Linda.
We're talking about the mom.
We're talking about the mom.
Okay.
Talking about the mom. So Alice is 58 and single. She's not married, so I don't have to worry about any of this in here.
Okay.
Do both of you do you qualify this? Did she do both of the following? Did she pay half the cost of keeping up their home?
Yeah.
Yes, she did.
She totally did, right? And do she got a qualifying child in her household?
Yep.
Possibility.
She does. Potentially. She does have a potential qualifying child. So if she was to claim that child, she's got a qualifying child. She's at a household. So let's think about that's if she claimed it. So if she don't claim it, she's single, right? She's just a single person. Yeah. If she does claim that child, she's had a household. Let's think about Linda.
Yeah.
What is Linda filing status? Was Linda married on the last day of the year?
Yeah.
Yes.
No.
Did her spouse live with her the last 6 months of the year?
No.
Her spouse did not. So spouse, they lived apart. Right? So yes. Did she pay more than half the cost of keeping up her home?
Nope.
She sure didn't. So she is going back to being married, filing separately. Because her mom paid half the cost of the home.
There you go. Okay.
So then Alice automatically is married, filing separately.
And
so
now,
whether she claimed the kid or not, she's married, filing separately. Does that make sense?
Yes.
So she can claim the kid and be married filing separately, but no matter what, her filing status is married filing separately.
Mm-hmm.
Correct.
So now the conversation goes, who is going to get the most benefit from claiming this kid, right? So would Alice get the most benefit because she can get head of household and claim this kid? Or would Linda get the most benefit because she's doing married filing separately and claim this kid?
Linda, I would believe, right?
Alice, because Linda has to file married filing separate, so she loses a lot of benefits because she's married filing separate.
But if she claims her child, that helps her out.
She's not doing head of household, so she don't, so she's married
Well,
filing separate. That's what disqualifies.
Well, isn't there a new rule?
There you go. There is a new rule.
Parents being separated for 6 months here and 6 months there.
There you go. That's exactly right, Michelle. So this is one of those situations where you play it out and here's what I would do if this was a real client with me. I would do it both ways because Alice could get head of household and EITC. Maybe, but I mean, you know what? She actually might not get it because how much money she made?
Her income,
she made 46,000. Yeah, so she's over the 43,000. So I wouldn't even do it with her. She's only getting it to try to get her head of household status. I would actually give it to Linda because there is a new rule, as Michelle just noted, where it says if you're actually I need to pull up the 4012 so y'all can see the rule. Give me 1 second. I don't think I have it. Do I have it in here? Let me see. I do not. I should have included that. 1 second, guys. In your 4012, what is this? I2. I think the second page. I want to break down that bullet.
Okay.
So this bullet here, there's a little asterisk. It says filing status can't be married filing jointly separately unless you meet the exception 3. So the exception is here. It says taxpayer can claim, this actually should have said 4. Taxpayer can claim EIC who are married, not filing jointly, who have a qualifying child living with them for more than half a year, which they did, and lived apart from their spouse the last 6 months of the year. This is a new rule. It used to be if you're married filing separately, EIC goes away. But if you are married filing separately away from your spouse the last 6 months of the year and the child lived with you for half that year, you still can get EIC. So in this case, Linda would file as married filing separately, but still get EITC for Nancy. So I would think that the credit for EITC, because she only made $25,000, her income was a lot lower than her mom. I would think she would get the bigger bang for the buck by claiming it. Now, arguably, I would do both just for exercise purposes, but my gut tells me that Linda would make out better.
Definitely.
Because she's going to get a large EITC credit because the threshold is 43,000 for one child, and she's like half of that almost.
Now, Alice, because she still takes care of more than half of the household, she can still do head of household just with no dependents. Oh, well, it doesn't matter because she doesn't even qualify. She's going to still be single because she doesn't even qualify for EIC. Never mind.
But no, you actually are onto a good question. Can she still do head of household? Because she does have a child in her household.
And she took more than half of
the year.
Right. So what I would do with her is file her as head of household. And I would put her on, let's see here.
Her or her, would you put her daughter or her granddaughter?
I will put her granddaughter on there.
As just claiming for head of household, no
dependency. Exactly.
Yeah.
No dependency.
No dependency.
I wanted to show you where you would put that.
It's a button in TaxSlayer. You just click it that this child is not. You put it on their W-2 like they are dependent, but you click the button and the dependent to say they're
so
not.
You know where this person would go? This person would go on here as I would do head of household and it would be in here, but it would not, the dependent
The
button, it would
dependent
not
would
be a
be
dependent.
checked, right.
It would be just checked off as somebody that I'm putting on my tax return to help me get head of household.
Yeah, none of those checks will be
But
there.
yeah, I would not get any of these codes. It's actually, the dependent wouldn't even show up here.
Yeah, it wouldn't.
It wouldn't even show up there.
Mhm.
All right.
Yep.
Any questions on that?
Yeah, I mean, no.
All right. Great job, y'all. You guys are definitely on top of this one. That could be a little tricky. All right. Let's do the polling questions on this one. Let's see if y'all really got it. For the purpose of determining dependency, Nancy could be the qualifying child of who? It's saying could be. For the purpose of determining dependency.
No, take that back, both. Mhm.
There you go. That was you. Okay.
No, that's it. No, take it back.
So the purpose of dependency, that was when we were doing this test. For the purpose of dependency, who could Nancy qualify? All right. So I know that one was you, Mia. So I think we're on the same page. So we're good. That person could have went either way, right? Either way. All right.
Correct.
So let's go. The next question was, Linda is not eligible to claim Nancy for earned income credit because her filing status is married filing separately. Now, is that true? We kind of walked through that. Can Nancy not get EIC because her filing status is married filing? Is that true or false? Linda is not eligible to claim Nancy for EIC because her filing status is married filing separately. Remember, we just talked about that little rule. There was that little rule that we just talked about. It looked like somebody answered that it was a true statement. I want to make sure that we understand this.
Okay, let's see.
Remember the little rule, that rule that we just read. We just read that on the 4012. The rule said if the person was away from their spouse the last 6 months of the year, what was it?
Last 6 months of the year, and and made that amount there. Okay, I hear what you're saying.
Yep. So they had a child living with them for half the year, and they lived apart from their spouse the last 6 months of the year. They can still get EIC, but file as married filing separately. All right. Right. This is a new rule that got put in last year, actually, and they kept it.
Oh, wow.
So that was not like that before last year. Before last year, married filing separately killed you no matter what your situation was. But now they have that little wiggle for if you left your spouse and they were not with you the last 6 months of the year, you're good to go. All right.
Okay.
All right. The last polling question, I think there was one more on this one. No, that was it. So there's only 2 questions. Any other questions around this one? This one could be a little tricky. There's some moving parts in here, but just understand the tiebreaker rule goes to the parent always. If they're both the parent, then you go to AGI. All right.
Now, let me ask you a question, which it might not even be a question that we might never run into. So my question is, you know how, okay, if both parents are trying to vie to claim the child, go to the one that makes the most income. Now, let me ask you a question. What if, because a lot of divorced people or separated, they have it ruled out.
That's
legally.
correct. Yep.
So when that occurs, and we always fall to what's legally?
Yep. So there's a form called an 8332, which basically tells the IRS who has the right, or who, based off of the divorce decree, has agreed that they can claim this child, and that would trump some of these other tiebreaker rules, because the divorce decree says that the parent, this parent can always claim this child for the next, no matter what the income was.
Gotcha.
But that's
so would that be the same thing if they brought in that we both have custody, but I'm primary physical custody in my home?
So that person would also want to figure out who, so let's say 50-50 custody, somebody, the primary will want to say, I'm the one that's going to be able to claim them. They're calling primary because they want to say, I'm the one to claiming them. That's usually the argument to do that. But if it's 50-50,
We still go with the higher income.
Yeah, that they both have the right to do it. But usually when you go to child support or whatever, somebody is named primary, and that would be the person that can claim them.
And then sometimes you'll see, 'cause I've seen it where they agree on, you could do it for these years.
They alternate. So that's usually the fairest thing. Is this that 8332? I don't have it one right in handy, but the 8332, when you fill it out, you can actually say on odd years or something, I'm going to be the one claiming this one. I think this is an 8332. I'm thinking I remember it by heart. Let's see if this is the form. Yep. So I'm releasing the exemption, and I'm saying I'm going to grade for the tax years ending in odd, like the odd years, right? So I can do odd years or something. But basically, I'm the primary. I'm releasing the exemption to the person that's the non-custodial parent, they call it. And I can say, like part 2, I can say release claims for future years. So I can say for tax years ending that are odd, I could say that. So every odd year, you can claim the child. That's every other year.
Now, Desmond, is this the same form that people use? Let's say you're going to allow your girlfriend to claim your children this year, and it's a form that the parent can relinquish and sign that allows that person that's not the parent to claim that child.
I don't think this is that form. I mean, this is a release of dependency to someone else. I'm thinking this is usually for parent to parent.
Yes. Right. Okay.
I'm not sure the form you're referring to for like a girlfriend or non-parent. That could be some legal document or something, or maybe some like agreement that they had, but I don't think that's what that's for, that 8332.
Okay.
All right. We ready to move on to the next scenario?
Oh yeah, I like that one.
All right, we're good. All right, so we have 2 more left. So we're going to move on to this is your itemization lesson. All right, so here we're talking about itemization. So what is itemization? So let me go back to my 1040 form real quick. So when you do your taxes, you get what's called a standard deduction. A standard deduction is a fixed dollar amount based off of your filing status that reduces your income. So over here, where it says standard deduction up here, so if I'm single, my standard deduction is $12,950. If I'm married, it's $25,900. If I'm head of household, it's $19,400, right? Depending on my filing status is my standard deduction. Your standard deduction comes in over here, number 12, right? So let's say I made $30,000. I had $30,000 in wages that would go up in box 1. That $30,000 would basically carry down and say, that's my total income, $30,000. If I had some adjustments like student loan interest, I could reduce that $30,000 by that. But let's say I have no adjustments and I get down to my adjusted gross income is still $30,000. Now, if I am head of household, I can reduce that $30,000 by $19,400. I'm going to round it up to $20,000 just for easy math. I could subtract the $20,000 for 30, and my leftover taxable income is $10,000. If I was to just call it $20,000. Or I guess the math is what, 10,600. I'm being lazy, but let's call it 10,600 after I subtract 19,400. Does that make sense? We're on the same page right there?
Yes.
Standard
deduction lowers your tax liability.
It lowers, no, not my tax liability, my taxable income.
Okay, yeah.
So now that 10,600 is what I figure out what my tax liability will be on. I started out with 30,000. I subtracted my standard deduction, and I'm left with 10,600. Now, an itemized deduction gives me the opportunity to come up with more than the standard amount that the IRS gives me. The IRS gives me a standard amount of X amount based off of my filing status, but I can go in and say, I want to see if I can get more than it. So in this example, this person, Ellen, is 48 years old and she wants to file as single. So as a single person, her standard deduction is $12,950.
Mm-hmm.
I want to know if I can itemize more than $12,950. So my benchmark when I'm thinking about itemization is saying, all right, let's see if I can come up with more than $12,950. All right, so let's put that over here. Because if I don't come up with more than $12,950, itemization does nothing for me, right?
Gotcha.
All right, so let's see if we can do that. So let's see, her AGI was 51,000 and she had gambling winnings of $2,000. She wanted to know if she can itemize, she would like to itemize her deduction. So let's see. So medical bills are something that you can itemize, but medical bills has a floor. Does anybody know what this floor is?
That's the cap. There's a cap, right?
There's a floor. They call it a floor, meaning that your medical bills have to exceed what percent of your AGI?
Oh no, I don't know that.
It's 7.5%. So I want to pull this form up. This is your itemized. So I need to 7.5%. You see this underneath medical? I need to first exceed 7.5% of my income. So $9,000 of hospital or doctor bills. My AGI is 51,000. So I need to do some math real quick and figure out what is 7.5% of 51,000. So let's do that math. 51,000 times 7.5% equals 3,825. Excuse my poor mouse writing. 3,825. I had $9,000 in hospital bills. So I have to go $9,000 in hospital bills, but I got to subtract out my floor. I have to start above any expenses I have above 7.5% of my income. My 7.5% of my income is 3,825. Am I making sense?
Yeah.
Right. So you have to subtract.
So I got to subtract out 3,825. So what's that math?
I don't have my calculator.
So I have
not even on my phone.
5,175 as my medical expense.
So are they okay, never mind. I see it. Gross. Never mind.
Yep.
Okay.
So I'd have 5,000. So even though I paid 9,000, I only can deduct 5,175. Does that make sense?
Yes.
The reason I had to do that is because medical has a 7.5% floor. All right. So 5,175 is my medical. So let's mark that off. Cool. How about the $500 contributions I made to my HSA? Can I deduct that as an itemized deduction?
Yeah.
Any other answers?
I thought, well, no, but I want to double check because I remember how before you could include what was given to you by your parent or whatever. Okay,
Right.
Yeah, no.
So let's make sure that we understand the difference between a deduction and an adjustment.
You said you can't if you itemize them.
So wait a minute. This is a contribution to an HSA. This is a deduction.
Okay, so yes, you can then.
So the answer is actually
so she can't add it.
No.
I
Yeah,
can't
she can't add it because it's a contribution out of the deduction.
So that's just so. Let me get something out for you guys because I think I want to make sure. This can be confusing. I want to make sure you understand this one. So there's two types of deductions. There's one that's called an adjustment, and there's one that's actually just called a deduction. A HSA is an adjustment. So it is a deduction. So we use the word deduction as loosely here, but an HSA right here, health savings account deduction, that is the contributions that I put into my HSA. And yes, what I'm gonna do is use it as a deduction. And yes, it's going to reduce my income, but it doesn't reduce my income there. It reduces my income. This is more of a lesson on the 1040. It reduces my income in a different area. It reduces my income here. I'm gonna show you. That adjustment reduces my income where it says adjustments. So down here where it has adjustments line 10, adjustments to income from my schedule 1 that I just was showing you guys. This is my schedule 1. I'm gonna pull that in the screen. This is a schedule 1. So up top it's called a schedule 1 up here. So schedule 1 has adjustments. These are all things that I can use to reduce my income. In here is that educator expense. In here is like student loan interest deductions. In here is also HSA contributions that can be treated as deductions. That stuff reduces my income and it goes on line 10 as an adjustment. It reduces my total income before I get to my AGI. This is even before I get to my AGI. After I get to my AGI, then I can reduce my itemized deductions. The reason I can't do the 500 because I already did it.
Okay, that's okay. So there we go.
It's already
So
in my 10.
right. Okay. So the adjustments will so the adjustments actually brought down the 51,000
exactly
before the standard deduction even went in.
Exactly.
Gotcha.
Exactly. So let's break that down a little bit more. Line 11 is my adjusted gross income. Remember, that's after the $500. That's an adjustment. When you look at your Schedule A, the Schedule A is saying, I want 7.5% of line 11 right here.
Okay.
That's my AGI, is my adjusted gross income.
Oh, that's why
I'm
it's
multiplying.
Called an adjusted one.
Yes, it's adjusted
it's after
by
all those
your
adjustments go in. Yeah.
Yep. So what's your adjustments? Adjustments are student loan interest, educator expenses, HSA deduction, IRA deductions. Those are all adjustments and they live on your Schedule 1. These are all a bunch of adjustments that you can use to reduce your income. There's a whole bunch of them. But this has nothing to do with itemized deductions because all that happens before I even get here.
Gotcha.
Does it make sense?
Yep.
Definitely.
So when I go back and I ask the question and say, well, can I deduct my HSA contributions as a itemized deduction? The answer is what?
No.
The answer is no, because I already would have done this as an adjustment. So I can't double dip. That would have been a double dip. We good?
Yep.
Yes.
Perfect. Thank you. So state withholdings. Can I deduct state withholdings? Let me pull over my Schedule A. I'm sorry, my Schedule A. I'm gonna pull over my Schedule A. Can I do state deduction? So I can do taxes you pay for state and local taxes. So can I include that?
No.
Can I include state withholding? Why can't I? I can do this. This is my deduction. This is my Schedule A.
This is itemized. I'm sorry.
This is my Schedule A. I'm back on my Schedule A. I apologize for that.
No,
Schedule A. Medical.
Right. Yes.
Taxes you paid. I can do state and local taxes. I can do real estate taxes. I can do personal property taxes. All of this stuff that I can do. So let's see. So can I do the 3,600?
Yes.
Yes. So I can do the 3,600. How about the $300 personal property tax? Can I do that?
Yes.
Because also that's included on this schedule in here, personal property taxes right here, right there, line C. So I can include that. So before I continue, let's look at real estate taxes. Can I do real estate taxes? That's property taxes.
That's property.
Yes.
That's $2,300. So that's 2,300 plus 3,600, which is what, 5,900? Plus another 300, we had $6,200 in taxes you paid. So in here, I can put $6,200. Does that make sense?
Yes.
My medical, I have what, 5,175. So 5,175 would be here, and in here would be that $6,000. One thing I want to point out is when you're dealing with medical, you have a cap of $10,000. No matter how much you paid in taxes, you can't go more than $10,000, and you can't go more than 5,000 if you're married filing separately. So let's say that this person
Now, is that medical? No, that's taxes paid.
That's only taxes. That's only taxes.
Okay.
So let's say this person paid $10,000 in real estate taxes plus $3,600 in state taxes and $300 in personal property taxes. So that would total what, 13,900, right?
He would lose.
Right.
They would have to cap it at 10. So 10,000 would come on line 7. They
And
can't
that's
go.
I'm sorry.
more.
And that's something that the system will do automatically.
That
even
is
if you
something.
put everything in, it'll
Yep.
just stop it at 10.
It'll stop it at 10. No matter what, you can't go by 10. But they're under 10, so they can do 2,300, 3,600. So that's about $3,900, whatever the math we said.
Right.
We said 59, 6,200. I think that's the math in my head. All right, so they're good with the taxes. We good with there?
Yes.
Good.
How about this GoFundMe money? Can I do that? To our friends GoFundMe account?
No.
I'm going to
I
say
don't think
no,
so.
because the only thing you can deduct are things to a non-profit 501c3 organization.
Okay.
That
so
is not,
charitable
your
contribution.
friend is not a non-profit. Even if it's through GoFundMe, GoFundMe is not a non-profit organization. It's a vehicle to collect money for donations. So it's
So would that money have to be reported on the cash side?
no, it's just I just gave money away. I
mean, if I received it.
If I received it, not necessarily. You would have to report it as, because it's not income. I didn't earn it.
Is that network thing?
Yeah, that would probably, if anything, that would be outside of taxes. Like, this is how much money I have. I can put it in my bank account. It's not money that I earned. It's
Right,
money that
okay.
I received for whatever
As a gift.
reason, like as a gift, kind of like from multiple people. I don't have to do a taxes on it because it's not one person that gave me this.
Okay.
It was added all together.
It was added all together, right? So then, how about cash contributions to the Red Cross?
Yes.
Can I
Yes.
deduct that?
Yes.
Sure.
Yes.
So that in here on my itemized deduction would go underneath gifts to charity. So this would be my gifts paid by cash. So they say any gift that's more than $250, I should probably have backup for it. So they probably wanted to make sure that I get a slip or something from the Red Cross. How
Yes.
about the $200 fair market value of clothing?
Yeah.
Because it's the Salvation Army.
Yep, to the
It's provided
Salvation
to the
Army. So
Salvation
that would
Army.
be called non-cash. So this is here, other than cash or check. Again, if it's over 250, make sure you have backup for it, right? And if it's over 500, I need to attach an extra form, because the extra form is going to do what it's kind of alluding to here. It's going to tell me what I paid for it. So it was worth $900, and the fair market value of it now is 200.
Okay.
If this was like $500, I had to fill out this form and break down what I bought, when did I buy it, what was the value of it when I bought it, and what is it valued at as now. So when you get over $500, there's like some extra steps you got to do, but most of our clients are under 500 or don't even itemize. All right, what about mortgage? The $7,300 of mortgage interest. Is that deductible?
Interest wouldn't interest be something like that was paid?
Interest you paid for mortgage, home mortgage interest and points is definitely deductible.
Yeah. Okay.
All right, I can definitely deduct home mortgage interest points. What you can't deduct in 2022 is PMI. Remember, we used to be able to deduct PMI in other years. They took that away. So be careful with PMI in 2022. How about a home association fee? Oh, I'm sorry.
I guess not.
No. Home association fee is not a deductible thing. There's no place on the Schedule A where they talk about home association fee. It's mortgage interest, it's taxes you paid, it's medical and dental bills, it's gifts to charity, casualty and loss, and other itemized deduction, which would be like gambling, would fall down here.
Mm-hmm.
So what about these gambling losses? Can I include this?
Yeah.
How much of it can I include?
Up to your winnings.
There you go, Michelle. Up to your winnings. So how much can I include?
$2,000.
$2,000. So I can put in gambling losses, but I can't put no more than what I won. So it would be $2,000 in gambling losses. So we went through this exercise to see if I can get more than $12,950, and I did, right? So there was $5,000 for medical. There's another $3,600 in state, so that's $9,000 right there. Another $300 in personal property, and I got another $7,000 in mortgage interest, so that's $16,000 right there. Another $2,000, so I'm up to like $18,000,
right?
Plus another $2,000 in gambling, so I'm up to almost $20,000 in itemized deductions, right? Yep. Makes sense for me to itemize because I would definitely itemize because it was my standard, again, was 12,000. Why would I give my client 12,000 when I can give them 20? So on here, it says standard deduction or itemized deduction. I'm going to say now reduce that 30,000 that I said by 20,000 versus just 12. And now I got a lower taxable income because I was able to itemize.
Right.
That makes sense?
Yeah.
We good? That's your itemization lesson. That's your itemization lesson.
Gotcha.
Great. Thank you.
This is what you can do for medical. So this is in your booklet on F6. So anybody come in and say, these are the medical stuff they have. You can say, you can't do some of this stuff. But this is what you can include. Mind you, when you do Schedule A medical, that over-the-counter stuff and menstrual stuff, that don't count. That only counts for HSA deduction.
Okay.
Not for medical deduction when you're trying to itemize.
Okay.
So just remember that little wiggle.
Yeah.
One thing I just want to remind you guys, if you recall, the last few years, you were able to do cash contributions that was what they call above the line. And when they call above the line, they meant like around here. I can put it in as an adjustment. I was able to do cash contributions of $300 per person or $600 for a couple. They got rid of that. I don't know if you guys remember last year, people was able to do that $300 above the line deduction, whether you itemized or not. They got rid of that. So you can't do that no more.
Oh, cool.
So just be aware of that. Cool beans?
Yes.
All right.
So
let's
that
do
means
the poll.
even if their deductions don't qualify as far as over the standard, they can still do contribution this year.
You can't use this year. Last year you could use it. You can't do that this year at all.
Right.
It expired December 31st, 2021. So no more of that. It wasn't into 2022. All right, so let's check these polls. Let's see what we got here. Scenario question 5. So let's say Ellen can claim 400 she donated to our friend's personal GoFundMe page. Can she do that?
No.
From what we learned. All right. I think we're on the same page. I got 2 responses. There we go. Thank you. I got share results, so we're good on that one. Let's do the next one. It says, what amount of gambling losses is Ellen eligible to claim as a deduction on her Schedule A? What amount of gambling losses? How much can she claim? We talked about that. How much can she claim? There we go. We're on the same page. Share the results. We rolling. We good. We good. We good. We good. So let's do this last scenario. and we can wrap up for the night. We're almost at the end.
What was the date? Was it the 31st or 12/21? I mean 12/31/21? Yeah.
Yep, 2021. That's when it was over. Yeah.
Okay, thanks.
Mm-hmm.
Because they're gonna be cussing me.
Oh yeah, that's
baby,
going.
I
You
need
can't
to
do that
have
no
the
more.
date.
Can't do that no more. So basically, just saying it ended in 2021. And once 2022 started, you can't do it, and that's the taxes we're doing this year. We're doing 2022.
Right, they're gonna be like, I did it last year. I said,
Did you know?
yes, I'll be like, yep, for your 2021.
Let's see here. So this is the last one. This is pretty straightforward. We got John. He's 26 years old. He's single. He provides all of his own support. He works at a grocery store, made $15,000. John was not a full-time student, but he took some like classes, some little one-off classes, and he wants to know if he gets a tax benefit for taking his management class, and it improved his job skill, right? So he did it to improve his job skill. So let's keep that in mind as we go through this. This one is pretty straightforward. His filing status is what?
Single.
Yep. There's no brain here. There's no trickery. He's a single person. He has no dependents. It's just him. Can he get EIC?
Yeah.
How old is he?
He's
26. And he made 15,250. So let's see.
Yep.
His earned income is what? 16,480.
15,20.
Look at his age. His age is good, right? He looking good. All right, so we good there. And then what kind of credit would he get? So there's the American Opportunity Credit, and American Opportunity Credit is available only for students that are like in their first 4 years of school, available only in their first 4 years. They're usually matriculating, they're taking classes. They are like at least a half-time student. And what was he doing?
He
was just working. He was taking
he was working
classes
and took
for
2
his
classes.
Mhm.
So what he was
the
doing,
lifetime.
he would get the lifetime learning, right? So the lifetime learning, he has to available all years, an unlimited amount of tax years. He does not have to be pursuing a degree. He can do drugs for this one.
Can he go to jail?
I think he is felony the drug conviction. It doesn't make him ineligible, so they good. So yeah, this is somebody that's really going to school and they're trying to improve their job skills, and that's what he was doing. He was improving his job skill, so he can use this. So just a little quick lesson: a lifetime learning credit is what we call a non-refundable credit, similar to that other dependent credit. So the credit is up to $2,000. So let's say this person's tax liability was $1,000 and they got up to $2,000 in lifetime learning credit, they won't get a kickback for that other $1,000. It's non-refundable. All they can do is wipe away the $1,000. While an American Opportunity Credit, you can get a portion of it, 40% of it, refundable. While the lifetime, I get none of it, I can get 40% of the American Opportunity Credit treated as refundable. So if I had no tax liability, I can still get, what's 40% of this, $1,000? I can still get $1,000 refund strictly because I can do that with American Opportunity Credit. If I had no tax liability for lifetime learning credit, I would get nothing because there's none of it. It's all non-refundable. Does that make sense? Lifetime learning credit is non-refundable. American Opportunity Credit, 40% of it can be refundable.
Okay, so that means sometimes when you see, once you put that information in and you see their refund change, that's because it's giving them those credits, helping their tax liability.
It's paying down their tax liability, or it's kicking it back as a refund if you're doing American Opportunity Credit.
No, I'm talking specifically lifetime that's not refundable.
When it's not refunded, you see it going down because they had tax liability. And yes, it's reducing their tax liability.
So that actually sometimes makes their refund go up.
That makes their refund go up because, yes, they're reducing the amount of taxes they had, because a refund is basically how much they won in taxes versus what you paid in. So your amount that you put in taxes went down a little bit. Yep. Another thing to know is who can't claim the credit. If you're filing separately, that's another penalty. for this. So you can't get a education credit if you're filing separately. So if you just, if somebody comes in and say, hey, I was in school and here's my 1098T and I'm filing separately, that 1098T means nothing to me because you're filing separately. That's one of those things where married filing separately is a bad thing.
It's
Victoria
a
was
bad
saying to it
thing.
earlier. There's certain things that married filing separately does. This is one of them. It gets rid of your education credits. It gets rid of child care credit, like certain things that it does to you.
Yeah, at one point it was getting rid of your darn dependents.
And they used to get rid of EITC 100%,
Yeah,
but now they got a little wiggle room now. So married filing separately is usually the worst thing that you can do. That's it, guys. Let's do this last pose. It's a pretty straightforward pose. It says John is not eligible to claim the lifetime learning credit on his 2000 tax return. Is that true or false? Is he not eligible? I hate when it says not eligible, but let's make sure you're reading that right. Is he not eligible to claim it? True or false? In the poll, I'm gonna share it. I think we're getting caught up on wording. Just be careful. If John not eligible for lifetime learning credit versus is he eligible? Is he not eligible? That's false, that he's not eligible, but he is eligible. So just be careful with the wording. They try to trick you with the wording. And then the last question is, which of the following is not a requirement for John to claim the earned income credit with no qualifying children? Which of the following is not a requirement? So does he have to be a full-time student? Must he be a dependent of another taxpayer? Must he live in the United States? Must he have a social security number? Like one of these is not a rule. Like must he be a full-time student? Must he have a social security number? Must he not be a dependent on another tax return? Must he live in the United States? One of these is not a requirement.
He does not. Well, okay, sorry.
Yeah, don't say it out loud. Which one is not a requirement? And if you want to, look at your 4012 and go to my little trusty page, I2. Which one of them is not even on there talking about it?
Okay,
claiming or someone else to be claiming.
And he does not have a qualifying child. So he does not have a qualifying child. You can look at my screen if you want. He does not have a qualifying child. Which one of those, one of these rules doesn't even come in play?
Mm-hmm.
All right, so I'm going to end the poll. I'm going to share the results. We got a little difference. I want to make sure we understand this. Rules if you do not have a qualifying child. He must be at least age 25, but under 65. So that's a rule. He can't be a dependent of another person. So whoever checked off must not be a dependent of the taxpayer. It says it right here. Can't be a dependent of somebody else. He must live in the United States for half the year, and he can't be a qualifying child of another person. So somebody else, he can't be an EIC qualified child. So remember, there's dependency, and then there's a qualifying child for EIC. So he can't be a qualifying child for EIC, and he can't be a dependent of somebody else. He has to live in the United States for half the year, and he has to be between 25 and 64. It says nothing about certain things on this poll. One of the things they didn't say anything about. We're on the same page now?
Yeah.
All right, I'm going to just run that poll again just to make sure that we are on the same page. Looking for one more answer. There we go. Thank you. We're all on the same page. Voila, we're done. So that's good. So we're on the same page. As you will note, when you go into your Link Learn certification, you can go back in and do your 2022 advanced exam. That first 6 scenarios, the polling questions are extremely similar to what the questions will be inside of the certification test. If you understood that through the class, you should do very well on the test. We got scenarios 7, 8, and 9 to do in advanced part 2. So come back for advanced part 2. That is going to be more of a tax layer class. And we're going to work through tax layer to do 3 problems and help you navigate the system. I'll show you some little quirky things to do in the system and how to utilize it most efficient. For now, I would encourage you guys to just go in, start the test, do scenarios 1 through 6, and then just pause until you take the second part.
Okay.
We good? Any questions
Yes.
about anything?
Nope, not at this time.
All right. Hearing none, thank you guys for coming out. I'm going to end this recording, and I'll hang around if you guys have any other questions. I'm going to stop the recording, but thank you guys. I'll see you in advance number 2.
Okay.
Okey-dokey.
Thanks.